Welcome back. Well, this morning non-farm payrolls were reported to have increased by 315,000, beating estimates of 300,000. The unemployment rate rose unexpectedly to 3.7 from prior month's 3.5%. The durable goods orders, which we received last week, were revised lower by 1%. Now that represents the first decline in 10 months. I think that was a big surprise to many. Also, on the FX side, the Hong Kong Monetary Authority has reduced 60% of the city's cash balance since May. What they're doing is following the Federal Reserve's lead, which last week they indicated, of course, higher interest rates are a certainty, and that's very much strengthened the Hong Kong dollar. We'll take a look at that in just a moment. First off, we have the non-farm payrolls. Again, indicating a very steady trend to the upside. The unemployment rate did tick higher. Now, the durable goods, which was really not great, but it was a short increase or a small increase. We can see now with the revision, it's actually registering the first decline in quite a while, 10 months to be exact. Overall, taking a look at the charts, notice the charts that have recently reversed course. Existing home sale prices, which was very strong, now turning lower. We see housing inventory, which actually I believe is better when it's lower, better for housing prices. The inventory has started to rise a little bit, and supply versus demand, that should weigh on house prices. The unemployment rate, of course, ticked higher. As the mortgage rate moves higher as well, that's adding pressure to the housing market. Durable goods is a little bit lower. University of Michigan confidence cannot find an uptick, just seems to move lower. Construction spending, we spoke about yesterday, that's now moving lower. New orders on manufacturing, that is now registering a little bit of a decline. The New York Empire manufacturing, residential construction, all those are moving lower as well. So we see quite a bit of negativity throughout the economic numbers. Now, year over year, notice the non-farm payrolls, and this compares this August to last August. So, taking into consideration seasonal factors, we can see the non-farm payrolls continues to show year over year smaller increases over time. So after the 2020 shutdown and the economy coming back, we can see a lot of that steam, I think, has been taken out of the economy. Now, moving to a little bit of a closer look at the durable goods orders, we can see registering just a slight decline now, and of course non-farm payrolls, which was an improvement, a little bit higher than expected, but not as great as what we saw before. Very specifically, though, we see also construction spending registers a decline. But very specifically, we can see that the non-farm payrolls has registered just a very small move to the upside. Taking a look at the S&P 500, now the top left-hand chart shows us every S&P 500 component, 500 stocks within that index. The last time we looked at this, and we can see on the right side shows us with histogram bars exactly where each component or each group of components lays out. So the highest line over here in the histogram bar represents all those stocks, about 131 stocks that have an RSI, a relative strength index between 40 and 45. We see a little bit less than that, around 80 stocks registering an RSI between 35 to 40. On the left-hand side, this shows us the grouping of the stocks. And the last time we took a look at this, the RSI was lower. Well, I should say it was higher up. We've moved lower as a result of the big down move we saw last week. Markets were a little strong yesterday, but now have closed in the negative territory again. Now, more importantly, take a look at the 52-week components. Again, every dot represents, in the lower left-hand corner, one stock in the S&P 500. Clearly, we can see the vast majority of the stocks are near the lower end of the range. The histogram bar on the bottom right-hand side shows us with greater detail exactly how weak the stock market is. Now, we're looking at, for example, the highest histogram bar here shows us that 54 stocks within the S&P 500 are at the 5 to 10% range of their own 52-week range. So imagine there's a stock that has a range of 1 to 100. Well, about 54 stocks are trading, at $5 to $10 a share, very, very close to the lows. All these tall histogram bars, we can see the vast majority of the stocks are within the 0 to 25% of their respective 52-week range. Most of the stocks are trading near the lows of the ranges. Now, the reason why we compare the RSI count, the relative strength to the 52-week range, the relative strength index moves more and is more sensitive to current market activity. So we're not really very oversold. In fact, oversold territory only happens really when we see stocks below 30. We're not there yet. This is telling us the stock market has a lot more room to go to the downside, despite the fact that we're near 52-week lows. Taking a look at the FX market, take a look at the number one strongest currency. These are RSI relative strength readings for individual currencies, not the pairs. The Hong Kong dollar is the strongest currency in our index right now. Thai baht number 2, Israeli shekel 3, US dollar with the Federal Reserve behind it number 4. The weakest currency out there is the Turkish lira, followed by the Swedish krone, South African currency as well. Now, what we want to do is match up the strongest to the weakest currencies in order to find the strongest currency pair. So we take, for example, the Hong Kong dollar over here. Moving on down, match that against the absolute weakest currency out there, which in this case is the Turkish lira. So if we were looking for the absolute strongest trend out there, we would look to go long the Hong Kong dollar, go short the Turkish lira. We could also take a look at the Thai baht, THB, match that up against also the Turkish lira. That could give us does give us a very strong trend. And of course, the US dollar is quite strong also. So this doesn't tell us necessarily where the beginning and the end of the trends are, but it does really show us where the brunt of the capital is moving out of one currency into another. The chart on the right-hand side shows us the rate of change of the RSI from one moment to the next, or one day, I should say, to the next. Over the past 24 hours, the Hong Kong dollar by far has been the absolute strongest currency out there. So has been the Mexican peso, which is actually gaining strength. Ironically, the US dollar, which has been, recently quite strong, has actually turned back to the downside. Now, I think this is a short-lived return to the downside only because the Federal Reserve continues to tell us that we're going to see higher interest rates. So maybe those traders looking to buy the US dollar, they may use this weakness as some sort of entry point. But point being is that we continue to see, and really the story flows through all the different markets out there, whether it's FX, fixed income, or stocks, that higher interest rates as a result of the inflation are driving stocks lower and driving the US dollar higher and driving bonds higher as well. And that really does contribute to the higher or the greater degree of inverted yield curve, which we talked about yesterday and many days before that. So on top of that, we see, for example, Indeed job postings. This is reported on a daily basis. As long as I've been following this, recently, it really has continued to move to the downside. Now, interesting, the PPI, Producer Price Index, also is turning just slightly to the downside. Remember, the Federal Reserve is on this campaign to raise interest rates to fight inflation. All this could change, of course, if we see inflation really subside and turn to the downside. And I think that is really what we want to look at in the next couple weeks, is to see how these inflationary numbers pan out. The CPI, the last report, was flat. The PCE, just slight decline. So inflation looks like it's weakening to an extent. Unfortunately, existing home sale prices, manufacturing numbers, those seem to be moving down faster. So we're going to keep a very close eye on that to see if we can see any further development, if the inflation numbers can give us an early hint as far as what the Federal Reserve may or may not do. With that said, we hope this has been helpful. We wish you a great weekend. We look forward to seeing you back soon.